You can feel it in the air. Markets look calm, charts look normal, but underneath, something's off. No crash, no panic, just silence. Investors, big and small, are quietly walking away. Not selling everything, not making headlines, just checking out. It's the financial version of quiet quitting, and you probably haven't noticed it yet, because it doesn't show up as a crash. It shows up as disinterest, volumes drying up, risk appetite fading, money sitting still, not moving, not flowing. And that, more than any headline, might be the biggest warning signal yet. Let's rewind. What happens when millions of investors stop playing the game, but still pretend they are? Markets lose their energy. It's like a concert where the band keeps playing, but the crowd's just staring at their phones. That's the market right now. Corporate earnings still post, analysts still tweet, brokers still market optimism, but behind the curtain, participation, real, skin-in-the-game participation, is quietly collapsing. And the numbers prove it. In the last year, fund inflows from retail investors in major economies dropped by double digits. Meanwhile, cash sitting in money market funds just hit record highs, over $7 trillion. That's not investors investing. That's investors waiting, waiting for clarity, waiting for conviction, waiting for someone else to make the first move. And when everyone waits at the same time, markets begin to suffocate. So how did we get here? Let's trace it back. In 2021, markets were loud, euphoric, stimulus checks, meme stocks, free money. Every chart looked like a moon mission. Then came 2022, the hangover. Inflation spiked, interest rates jumped, and suddenly the floor beneath infinite growth cracked. Fast forward to now, inflation cooled, but optimism didn't return. Rates stayed stubbornly high. And instead of saying, "I'm out," investors quietly did less and less. No protest, no exit, just inertia. It's not fear of losing money anymore, it's fear of being wrong again. Quiet quitting in the workplace is about people doing the bare minimum to hold on to their jobs. Quiet quitting in markets is about investors doing the bare minimum to pretend they're still engaged. Rebalancing every few months instead of researching. Keeping old ETFs instead of exploring new ones. Scrolling financial news but never acting on it. It feels safe, but here's the irony. Widespread apathy is not stabilization. It's potential energy waiting for a trigger. Because when suppressed behavior builds up, one event, one policy change, one shock is enough to break the quiet. Financial history is full of these moments. 1999, everyone euphoric, then collapse. 2007, everyone complacent, then collapse. 2024, everyone cautious, but waiting. So, which one is more dangerous, euphoria or exhaustion? Euphoria blinds you. Exhaustion numbs you. Both end the same way, in surprise. Here's the uncomfortable math hiding beneath the surface. Equity valuations remain elevated relative to long-term earnings. Corporate margins are narrowing, not crashing, but quietly shrinking. Household savings are depleting, while consumer credit climbs. This isn't doom, it's fatigue. The system's running, but participation is hollow. It's like watching the engine idle when the tank's almost empty. Looks smooth, sounds fine, until it stops. And yet, the headlines, they keep selling resilience. Stocks holding steady, job markets strong, consumer sentiment improving. But strong compared to what? Compared to the chaos we just survived, or compared to long-term health? That's the hype versus reality gap. And that's why most people aren't scared. They're asleep. At this point, let's pause. Have you felt yourself losing interest in the markets lately? Checking your portfolio less often? Hesitating before making a move? I'm genuinely curious, because that's happening everywhere. And if you've noticed this creeping fatigue too, that's exactly why we break down stories like this. not just to predict crashes, but to understand behavior. If this kind of analysis helps you see patterns before the headlines do, you'll probably want to stay tuned here, because the next few months won't be quiet. Now, back to the story. Let's look under the hood of this quiet quitting behavior. When investors pull back, liquidity shifts. Banks, funds, and institutions adjust quietly, tightening credit, reducing leverage, lowering exposure. Those ripples compound. Imagine a lake on a windless day, still, reflective. But if the water level's dropping and no one's refilling it, dryness spreads before the surface even changes color. That's what quiet quitting looks like inside capital markets. Fewer trades mean wider spreads. Less participation means more fragility. So when shockwaves hit, whether from geopolitics, energy, or tech, there's less cushion. Markets don't just react faster, they break faster. To see this clearly, look at the timeline over the last 5 years. 2020, forced shutdowns, then explosive stimulus. 2021, record IPOs, meme bubbles, and stocks only go up. 2022, inflation, rate hikes, the reckoning. 2023, relief rally, powered more by habit than conviction. 2024, the quiet year. And 2025, the year investors quietly disappeared. That's the silent transition we're living in. From mania to maintenance, from trading to watching. But doing nothing isn't neutral. Money always moves, if not by you, then by the system. When investors stop allocating capital to productive assets, capital pools elsewhere, into government bonds, corporate buybacks, or passive instruments. So ironically, the system grows more dependent on fewer decision-makers, fewer hands steering a larger ship. And history tells us, concentration breeds fragility. We might already be seeing the early cracks. Volatility indices are creeping up from historic lows. Corporate defaults in 2025 quietly doubled year over year. Central banks subtly shifted tone, not hiking, but not cutting either, just waiting. That's the global mirror of investor behavior. Even policymaking has started to quiet quit. Central banks are saying, we'll respond if needed. Investors are saying, we'll invest if it's clear. Everyone's waiting for someone else to make the move. That's not equilibrium. That's paralysis. There's a strange irony here. The system built on confidence is now sustained by hesitation. Because as long as no one panics, it all looks perfectly fine. But that equilibrium is fragile. It only works if the silence continues. And silence never lasts forever. Here's the final twist. When active participation declines, algorithms fill the gap. AI-driven funds, quantitative traders, and passive flows now account for over 70% of daily market activity in major exchanges. Think about that. Humans barely steer anymore. Machines trade momentum derived from humans who are no longer participating. That's not just quiet quitting. That's quiet substitution. And it changes everything. Because if the market is moving based on programmed logic rather than emotional conviction, the next event might not trigger panic. It might trigger mechanical acceleration, a feedback loop. No emotion, no hesitation, just raw reaction. So what's the takeaway? Not panic, not retreat, just awareness. Investor quiet quitting isn't about laziness. It's about trust. A shrinking belief that markets reward effort or insight, that the game is still winnable or even fair. That's the silent threat beneath today's apparent calm. When belief fades, capital follows, slowly, then all at once. And history suggests it's in these quiet phases, these drawn-out pauses between storms, that tectonic shifts begin. So maybe the real question isn't, are we heading for a crash? But what happens when the crowd stops caring? Because once participation dies, even honesty in markets stops being priced in. Maybe that's the real warning signal, and maybe we're already hearing it, just too quietly to notice. Thanks for watching. Don't forget to like, share, and subscribe.